see here that the market sentiment has changed to neutral after we saw some buy and bullish buy recommendations. And we started to see those, of course, right here around, well, we got 39.24 is when the, 39.08 is when the bullish buy started to come in. So it moved up a little bit as we expected. Expected some slight movement there in that case. Now I bring this up. We're going to start here. I don't have a full presentation on this. But earlier today, Max had sent me an email, and he had one question related to the strategies in a portfolio to use and proper position sizing for optimum return and risk. Well, I have my thoughts on that. We might touch upon that in a little bit. But then he had another question that came in. And his second question, we do have sort of webinars on this, but not directly related to this topic in a sense. So what Max was asking is, how can I use the market sentiment tool to predict call buying and put buying, and how can it help me determine which strikes to buy? Okay, now we have a powerful tool called the Long Option Finder here in PowerOptions. And what the Long Option Finder does, it's under the signature tools, or you can find it under long call or long put. And the Long Option Finder is essentially a theoretical calculator based on the Black-Scholes pricing models. And it says if you have an expectation that a stock might move up 5, 6, or 7% or so in the next 20 to 30 days, what call would you buy? Do you just buy the at the money call? Do you buy the out of the money call? Do you buy the in the money call? Well, let's take a look at SPY right now. We're at about 4,000. We expected a 5% move in the next 30 days. This is not a recommendation, projection, or suggestion. Excuse me. But if I expected a 5% move up to 4,200, let's say, we're going to use SPY. And I expected this, let's say, right after September expiration, or right around September expiration. Now let's go out to the 30th. Sometime between now and the 30th, maybe I'm expecting SPY to be up to 4,200. Let's just put in an investment amount of $1,500. Now, what this tool does is it goes out. It's going to take a while. I shouldn't have used SPY, but we did. It's going to go through every available option on SPY. And it's going to calculate what all of those options would theoretically be worth if SPY was trading at 4,200 on September 30th. And it's going to show us which call would give us the best return. Now, this is why I didn't want to use SPY. Let's go back to this one. It works. It's just that these are outrageous numbers that are being selected because of all the weeklies 2 and 3 days out. And it's showing deep out of the money ones with a very weird, 475. Oh, that's because I'm stupid. Sorry, folks. Let's try that again. Let's go up to 420 and use SPY instead of using 4,200 for SPX. That would work much better, won't it? All right. And we said 930. Okay, let's get it right this time. Okay, it's doing something. I apologize for that. So anyway, what it's going to do here, let's change this to 420. It's trying to force me to default to these. I don't know why it got stuck in that loop. I'm going to have to look into that. Okay, I'm sorry, folks. Let's try this again. Get it right this time. And of course, like I said, there's so many options with the Monday, Wednesday, Friday expirations and all of the weeklies. All right, fantastic. So what this is telling me is that if I expected a 5% move on SPY, and I was going to invest $1,500 into the options and hit that target date at 9:30, the October 405 call, October 3rd expiration, 405 call, 24 days out with a current price of $846 would give us the best bang for the buck at 79% if SPY was trading at 420 and 930. Does this make sense? Well, we know what the price currently is, $846. With my $1,500 investment, I could only buy one contract. Okay, that makes sense. the estimated call price of 15.14 on September 30th for an October 3rd expiration, which would be the Monday, if I'm not mistaken. Does that make sense? Absolutely. SPY is at 420. We're looking at the 405 call, so it'd be 15 points in the money with roughly 2 days to expiration, so an additional 14 cents a time premium. Now, this is a very powerful tool. Of course, if I thought SPY would drop down to 380, I could put that in as well, leave the same monetary amount, leave the same target date. A little bit, think the market's going to pull back down to 380, about another, of course, 5% drop on the stock position as well. But of course, now the system is just going to show me which one, which put options would give us the best theoretical return in this case. And again, not surprising, the 3rd of October, 397 put at 526. We could buy 2 contracts. And if SPY dropped to 380, it would be worth about 1695. Does that make sense? Well, certainly it does, because it would essentially be 17 points in the money. So it'd be just about, probably higher than this, probably be 1710 actually in reality in those cases. And this would be a 222% return for that 20-point drop on SPY in the next 20 to 30 days. So, what do we know about the market sentiment tool? Well, last week we showed in part 1 of the can we get 3% profit? Is that possible? We called it moving with the markets. And even though SPY has been overall bearish over the last year, we've had ups and downs. We've all been trading. We know that. It's been sort of a tough market to do. But let's just take a look here. Year to date, of course. Just 1 second, folks. All right. There we go. So we started the year up at around 480 or so. And now we're down a little bit below 410. We've dropped as far down as 360. Now, okay, 365. But come back up, come back down. A little bit of a roller coaster here and there. And in the previous presentation, what we showed is that even though the market is down from where we started in January, if you just traded bear call credit spreads with an 85 to 90% probability this entire time, your portfolio would still be down 17%, or that portion of your portfolio. If you did bull put credit spreads, you're down closer to about 87% of what you started out with. But if we followed the history of the market sentiment tool, what we see here, let's go beginning of the year, when we started to see the sell indicators and going into the bearish sell modes, the bearish warnings, of course, when they started to appear at the end of December, and then we saw the bullish buys a little bit here, and then we started to see a little bit of neutrals. We saw the bearish sell warnings again as the market climbed, and then it collapsed, and we started to see the bullish buys, a little bit of a fake out here. We talked about that last week, what happened here from June 9th to June 13th. And we get the strong buys again, and on August 15th, we got the strong sells. We pulled back. We started to get the strong buys again last week, and so we're seeing the market move up again. What I have to do for further analysis for Max in this case, and you kind of already saw it, and you can kind of see it from the chart, there's a difference in the targets between a very bearish sell warning, in these cases here, versus just mild. From time and time again, little hiccup here, up, little hiccup here. Okay, we're moving along. We started to get the sell warning signals here. We have a little blip here, but when we get the big ones, we get the big ones, right? And this one was pretty significant as well. Not as significant as I expected, actually. But in any case, here and here, we're seeing good movements upwards from the bottoms. But this 2 warnings here, this was on the path until Powell spoke again, 6/9 to the 13th. But then these very bullish signals that happened here in July, or starting at the end, I'm sorry, of June 15th and 14th, if I am not mistaken. Let's get a little bit closer there. That was a signal for a much larger movement from about 3,700 up to about 4,300. That's a 600-point move. This is SPX, of course. Okay, so that's a 600-point move. So that was pretty significant, but then the warnings triggered again, and we came back down to about 3,900. What I'm talking about here, Max, is the analysis I don't have is when you see the very bullish buys, deep green ones, 2 or 3 in a row. Is that an indication of maybe more than a 5% movement upwards? Is it closer to 7 or 10% historically? I've never looked at it that way. What am I talking about? You see sell warnings, bullish buy, light buys. This is what I'm talking about. The deep green, very bullish buys, 614, 615, 617. That was this period here, that second top there, which that movement. Here we just see some light bullish buys, and it does move up, but it's a much smaller movement. Here we see some sell warnings, but we get 2 bearish sells in a row on August 15th and August 16th. Triggers a larger movement. This last one, we just had a couple of light bullish buys, but it was noticeable that the market started to recover slightly after those slight bullish buys were triggered. Not a lot, from 39.08 to where we are now at about 40.67, so a little bit more than 100 points for SPX or 10 points for SPY. Okay? And why is that important? Because using the long option finder tool, if I'm seeing those deep green, very bullish buys, that might lead me to believe that possibly a 7 or an 8% increase is possible, which means that's the expected price I would use. If I only see light bullish buys, and I'm saying to myself from the market sentiment, that's probably only indicating maybe a 3 to 5% movement, I'm going to see different options. It's possible if you go too far out of the money, only expecting a 3 to 5% movement, you won't see a profit. And if you go too deep in the money, your profit might only be 5 or 6%. So that's why the tool is useful. But Max's question is related to how can I use the market sentiment to know, hey, when I see those big red bear sell signals, which put strike to buy, and when I see the big dark green very bullish buy signals, which call to buy, it's going to be different likely than the light green slight buy or the sell warnings, just the light pink or light red warnings that come up. That's why it's difficult to predict. Now, you've heard me recently in webinars say that I've been using the market sentiment tool to adjust the out of the money strangles on SPY, and I still have been. I made the adjustment on August 15th. I made the other adjustments Monday when we started to see the bullish buy warnings come in. So that's been adjusted again to the 0.3 delta going out about 50 days, 45 days out of time. But what I don't have, Max, is just buying the call side and buying the put side. But that's what you'd want to consider, is that how strong is the signal and how strong of a movement are you predicting based on that signal? And I know you're asking me to show you some history to determine, hey, when I see these very bearish sell warnings, what kind of negativity does that preclude or lead to? And when you see the strong dark green bullish buys, what kind of movement does that on average historically see? So you can help pick a number to put into there for SPY or for QQQ for calls and puts, or even just stocks in general. But the whole point of the long option finder is you want to predict where you think the stock's going. And it's not easy, but if you call me up in a coaching session and you said, I'm bullish on Starbucks and I think it's going to have a good movement up in price, so I'm looking to buy calls. Well, you don't just have a good movement. You say, oh, well, Starbucks here is at 88, 89. It pulled back today when the market was up. It had a big move yesterday. I think Monday and Tuesday, it might go, by the end of next week, it might be at 92 or 93. That's why you're buying a call. So that's the price we'd want to put into that long option finder to identify which option would give you the best potential bang for the buck in those cases. Now, of course, don't get me wrong. If you think the stock's going up and you're right, if you buy slightly in the money call, you're going to have a profit. Yes. Is it necessarily going to be the one that would have appeared on the long option finder? Not necessarily.